Nigeria is often promoted as the largest market for renewable energy in Africa due to its potential to serve millions of previously inaccessible customers with reliable power supply. Local financial institutions are beginning to realize this undertapped potential as they continue to seek profitable opportunities to exploit within the sector. One of Nigeria's reputable banks has partnered with a renewable energy company that provides solar systems to rural off-grid communities to develop a mobile payment platform for pay-as-you-go solar solutions, thus improving the payment options for clients in rural Nigeria. Another bank is providing solar energy loans to households and small businesses for solar power systems, while a microfinance bank, on the other hand, provides solar energy loans of up to 3 million naira for households and 5 million naira for small businesses. Despite the financial support provided by these banks, there is still a major financing deficit in the renewable energy sector. Getting a loan from most local commercial banks to fund a renewable energy project is fraught with many challenges, ranging from high interest rates to short-term loan tenors. Solar energy projects are often capital intensive and require a payback period of at least 5 years. Yet, most commercial banks offer tenors that are shorter than 3 years, with interest rates in the double digits, and this is usually accompanied with grueling collateral obligations too difficult for most renewable energy developers to meet. Even under government social intervention funds managed by these commercial banks and other participating financial institutions, exorbitant interest rates are sometimes set at their discretion and are often coupled with sizable collateral demands that make these supposed government intervention funds inaccessible for a lot of local renewable energy companies. Direct government intervention funds for the sector that bypass commercial banks and other private financial institutions are a lot more profitable for developers, as they come with lower interest rates and longer loan tenors. Despite their apparent ease to access, renewable energy operators have cited certain bottlenecks in accessing financing from these intervention funds. Operators have stated that intervention funds can at times be highly bureaucratic and difficult to access. One example is the Central Bank of Nigeria Power and Airline Intervention Fund, which was launched in 2011 for the power and aviation industry. With a total budget of 300 billion naira, it aims to address the two main challenges faced in the sector when accessing financing: tenor and high interest rates. The fund's administrative agent is the Bank of Industry, while its technical advisor is the African Finance Corporation. Developers attempting to seek this fund have raised concerns at its strenuous application process, which sometimes requires expensive permits and licenses. In 2017, the Bank of Industry established a 1 billion naira solar energy fund that has since been expanded to 6 billion naira. Renewable energy providers can access these funds directly from the Bank of Industry. The Solar Energy Fund also boasts of an attractive interest rate, but the Bank of Industry will only accept proposals from developers based on aggregate request, and they prioritize high-value projects in the range of 50 to 100 million naira, suggesting that smaller scale projects will face issues accessing the fund. Nigerian renewable energy developers often receive financing from international financial institutions because they tend to understand the financial requirements of the renewable energy sector better than local institutions. However, working with international funding carries an enormous currency risk due to unstable exchange rates. A lot can be learned from the Nigerian agricultural sector, where guarantees are provided to reduce the credit risk for investors, thereby making funds more readily available to farmers. In the past, commercial banks were risk-averse towards agricultural investments, largely due to the lack of an existing framework to provide risk guarantee, as well as limited knowledge in managing associated risk in the sector, much like today's renewable energy sector. But the federal government stepped in to reduce lending risk by developing finance and risk management strategies through programs like the Nigerian Incentive-Based Risk-Sharing System for Agricultural Lending (NIRSAL). As a result, lending risk was lowered and financial strategies were implemented to deepen access to funds for small-scale farmers. In addition, policies were developed to encourage investment in the agricultural sector through tax reliefs, public-private partnerships, and other initiatives. As with the agricultural sector, the government should introduce tax credits, in this case for renewable energy equipment, and also consider backing guarantees on renewable energy projects. There needs to be continual engagements between project developers and financial institutions in order to better develop bankable projects. This will help expand the understanding of the renewable energy sector and reduce its high-risk perception. Administrators of intervention funds should seek collaborative partnerships with private organizations like the Renewable Energy Association of Nigeria to effectively facilitate stakeholder engagements with finance providers, aid agencies, and the renewable energy developers to come up with favorable financing policies and frameworks that work for growing renewable energy companies in Nigeria. Finally, intervention funds must always consider renewable energy's high capital requirement. They should offer single-digit interest rates and reasonable eligibility requirements, especially for small-scale developers. This recommendation also goes for government intervention funds managed by commercial banks and other participating financial institutions. In the last 5 years, renewable energy has emerged as a viable source of power in Nigeria, in line with the global movement towards clean energy and reducing carbon emission. Nigeria has set a goal dubbed Vision 30-30-30, aimed at electricity generation of 30 gigawatts by 2030, with renewable energy making up 30% of the national energy mix. But achieving this feat may be an uphill task without appropriate financing policies for renewable energy projects.